This content is for educational and entertainment purposes only. It does not constitute investment advice.
One rule, one trade per day, no matter what the market throws at me. Can a single level, a simple ratio found in nature, beat the market? Traders talk about Fibonacci retracements like they're magic. The 618 level, the golden ratio, is supposed to be where price bounces. In this week, I'm putting it to the test. No filters, no second guessing, just one trade a day, strictly at the 618 level. And if all goes perfectly, I'll have the golden ratio paying my bills. And if it doesn't, you get to watch me slowly turn my account into a Fibonacci spiral. But before we understand why traders swear by this level, we have to go back, long before charts, candlesticks, Trump pumps, and Pelosi profits, to where this number first appeared. The number is 0.618, known as the golden ratio, and ever since life itself, it's been hiding in plain sight. You can find this mysteriously precise ratio in the spirals of seashells, the petals of flowers, and even in the shape of hurricanes and galaxies. It's everywhere in nature, in art, in life itself, and on every trader's chart at 3 in the morning. But this sacred number found its 15 minutes of fame long before TikTok, back when going viral meant literally catching the play. You see, this somewhat holy number was famously linked to the Fibonacci sequence by the Italian mathematician Leonardo Fibonacci in the 13th century. His sequence of numbers, 1, 1, 2, 3, 5, 8, 13, when divided, revealed ratios that converged toward this same number, 0.618. This revelation basically made Leonardo Fibonacci the first ever content creator of the golden ratio, turning him into the first guy to make math go viral. But it wasn't until the 20th century, almost 2,500 years after its discovery, that this ratio made its debut in trading, all thanks to a trader named Ralph Nelson Elliott, also known as the father of Elliott Wave. In the early 1930s, Ralph developed something called the wave principle, noting that market movements often form repetitive patterns of 5 waves up and 3 waves down. But as Ralph adhered to this principle for years, he realized something strange. He noticed that the proportions between these waves often aligned closely with Fibonacci ratios, or more specifically, the 61.8 retracement level. Word of Elliott's observation spread all across the trading realm, but most importantly, catching the attention of a young technical analyst, Charles Collins. Collins was intrigued, not just by the waves themselves, but by the mathematical rhythm behind them. And so Charles reached out to Elliott, sharing books, spreadsheets, any data he could find on the golden ratio and its patterns in nature. And when Elliott finally compared Collins's golden ratio references to his market waves, everything clicked. The markets, he realized, moved to the same rhythm as nature itself. And as any trader would, Collins saw the real opportunity in this discovery. So he made Elliott an offer he couldn't refuse, to package the discovery into a $5,000 trading course. Because deep down, Charles knew one thing: selling the dream of being a trader often pays better than actually being a trader. All jokes aside, by the early 1940s, Elliott's health was failing. You could say he was entering the final wave of his lifespan. Confined to his home, he dedicated those last years to perfecting his theory, determined to leave behind a blueprint for understanding the markets that would benefit traders for all of eternity. While Elliott refined the philosophy, Collins brought it to life on the charts. He began plotting Fibonacci ratios, specifically the 61.8% retracement level, directly onto price movements. Retracements, extensions, fans, tools born from this bridge between nature's code and market behavior. And it was through Collins' practical application that the golden ratio transformed from a mathematical curiosity into one of the most watched levels in trading. And decades later, traders still draw that same line, because nothing screams edge like a horizontal line that everyone else is already watching. So that's the history. But history doesn't make me money. I'm not here to worship the golden ratio. I'm here to test it, to see if this number, so celebrated in nature and art, can actually give me an edge in the markets, or if it's just another way to look at a seashell. Here's how it's gonna work. I'm trading only one level, the 61.8 retracement. Nothing else, no other indicators, no moving averages, no trend filters, just price, a retracement, and me. Each day I'll identify a clear swing high and swing low on my chart, and from there I'll draw a Fibonacci retracement and mark the 618 level. My rule is simple here. When price retraces to that level, I enter. Long if we're coming from a swing low, short from a swing high. No hesitation or second guessing. I take my trade, set the stop right at the swing point, is a 1-to-1 risk to reward. If the market hits my stop, I'm out, and if it hits my target, I take the win and I'm done for the day. No paper hands. One trade, one shot, one gamble disguised as science. That's it. This way, the results will speak for themselves. Now let's see if the golden ratio is truly golden, or if this is just another week I'll be donating my entire account to the market. Armed with nothing but a retracement tool and 2,500 years of math hype, I set out on day 1, hungrily scanning the markets far and wide for my first Fibonacci trade. And there it was. The perfect setup on the Bitcoin 5-minute chart. Swing low, swing high, retrace right into the 618 textbook. This was it. The moment Fibonacci would finally stop being astrology for men and start paying my rent. So I pulled the trigger, and within minutes the market turned my perfect setup into a perfect stop out, straight through the 618 like it was running from debt collectors. Day 1, first trade, and true to form, the market came around early for its weekly donation, with my account first in line. But in the middle of that stop out, I noticed something extremely important. When price tagged the 618, it did bounce hard, not enough to hit the target, but enough to make me wonder if there was more going on at that level than trading's favorite bedtime story. So after day 1, I was down a trade but up a clue. Day 2, I spotted another setup. Swing high, swing low, retrace right back into the golden pocket. It looked clean and it looked obvious. And after yesterday's donation to the market's retirement plan, I needed Fibonacci to stop being one of those ancient wisdoms that only makes money for the guy teaching it. And this time price tagged the 618, held the level, and hit the target, just like they said it should. Which, let's be honest, feels a little suspicious. Still, a win's a win. But after one loss and one win, all I'd really proven was that Fibonacci flips a coin just as well as I can. Still, that mystical little bounce managed to turn into a full profit. And for the moment, my portfolio was actually up on the week. And then trade number 3 came. Another clean swing, retraced to the 618, textbook setup, just like before. Breschample win, I thought trade 3 was finally giving me real Fibonacci magic. Turns out it was just Fibonacci at home. Price cut right through my level and straight into my stop, and I immediately decided it was time to diversify my portfolio. 25% crypto, 25% stocks, and 50% plasma donations. After trade 3, I won't bore you with every single chart. The rest of the week was a mix of wins and losses. Just enough action to waste my week, but not enough gains to keep me from picking up side gigs in the Home Depot parking lot. And when the dust settled, the golden ratio had left me with a net loss. But even though I ended the week adding that loss trading Fibonacci, that doesn't mean fib retracements don't work at all. I only tested one very specific way of trading them, and if I could redo the experiment, I'd definitely approach it differently with everything that I learned. And trust me, I learned a lot in the process, and I want to share with you the 3 most important takeaways from this lesson. First, almost every time price hit the 618, there was a reaction. The problem wasn't the bounce, it was my targets. I was expecting too much. Most of the time, the bounce would stall before hitting my full take profit. Something like an ATR-based target or one tied closer to market structure could have captured those moves far more efficiently. Second, I learned that timeframes matter. Pulling Fibonacci levels on the 1-minute or 5-minute charts was just noise. The higher the time frame, 30 minutes or above, the more likely I was to get something usable. And third, focusing on only the 618 level was too rigid. Highlighting the broader 382 to 618 zone and then waiting for a clear reversal confirmation worked much better. That extra flexibility turned random stop outs into smarter entries. So no, Fibonacci didn't turn me into a millionaire, but it did turn me into a part-time DoorDash driver, where my stop loss is only one bad review away. Turns out customer tips are more reliable than Fibonacci bounces. But hey, if you want to see me put more trading myths to the test, make sure to like the video, let me know in the comments which strategy you want me to test next, and subscribe. It really helps the channel a lot and we really appreciate it. And if you want to keep up with what I'm testing next, or you're looking for a trading home, join our Discord community of active traders, follow us on TradingView and Twitter, and check the links in the description. We've also got an affiliate program if you want access to some of our Trading IQ execute tools, and of course, that's an affiliate link, so it helps support the channel. And just a reminder, nothing in this video is financial advice. These were simply my own trades and experiments shared for educational and entertainment purposes only. Thanks for watching, and I'll see you in the next experiment.